You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector SPDR ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
I'm DeLegge with ETFguide. Welcome to Marketplace Minute. Well, on today's episode, we're going to evaluate a $1.2 million investment portfolio, and I'm going to give it a final grade of A, B, C, D, or F. Now remember, my portfolio challenge stands to all of our viewers. If your portfolio scores an A on DeLegge's portfolio report card, I will pay you $100. So we're going to evaluate this portfolio. Just to give you some background about the owner, JP in Virginia is 51 years old. He's married, and this particular portfolio is divided among a taxable brokerage account, a non-taxable or tax-deferred 401k plan, and a Roth IRA. All these accounts are held at TD Ameritrade. And we're going to take a look at some of the individual holdings across 5 key categories: diversification, risk, tax efficiency, performance, and of course, cost. Now let's begin in the first area, which is diversification. Now remember, good diversification is not about how many holdings your portfolio has. Rather, it's about how well your portfolio has exposure to some of the major or key asset classes, not just stocks and bonds, but also commodities, real estate, cash, and tips or bonds. So let's take a look at JP's investment portfolio. Does a really good job in terms of diversification. Has exposure to U.S. stocks and international stocks, emerging market stocks, also bonds, tips, real estate. Again, it does an outstanding job in terms of diversification. The only real major asset class I see missing in this $1.2 million portfolio is commodities, which again is a major asset class. All well-built portfolios should at least have a little bit of exposure to this major asset class, commodities. In this case, JP's portfolio is missing that area. Otherwise, a pretty good job on diversification. Next up is risk. Now, this particular portfolio has an orientation or allocation of about 74% to stocks, that's US and international, 16% to bonds, and then the rest in cash and money market account. So for someone that's 51 years old, and he told me that he plans to retire in 6 to 10 years, and he also told me that he feels that even with that short time horizon, 6 to 10 years, he feels like he can invest with a 30-year time horizon. Still, to have that much exposure to stocks, 74%, for somebody that's pretty well educated and pretty well informed, even so, that's a pretty high exposure to stocks. And I think for that reason that JP needs to do a better job in reducing some of that exposure to stocks. Now, I know stocks have done well over the past several years, but still, there's a very big risk here. If we get a 40 to 50% correction in the stock market, guess what's going to happen to this $1.2 million portfolio? It's going to probably be worth a lot less. My estimate is this portfolio is definitely going to fall below $1 million if we see that type of scenario of a sharp correction. So I don't want to see that happen with JP's portfolio. And for that reason, I think he's taking too much risk in terms of his allocation. Next up is cost. Now, one of the things I look for when it comes to investment cost are investment portfolios that deliberately minimize investment cost. Now, that's not just annual expenses on funds or ETFs or what have you, but it also includes minimizing the cost of trading commissions. And in this case, JP does an outstanding job. Most of his ETFs are from iShares. He does have a couple of Vanguard ETFs, and all of them have very low expenses. What I mean by low, under 0.5%. And he does a pretty good job in minimizing his investment expenses. So excellent job in terms of cost. Now, next up is tax efficiency. Here too, we look for investment portfolios that minimize the negative impact of taxes. And in this case, JP's portfolio does an outstanding job. Now, I told you that he's got a brokerage account, a Roth IRA, and a 401k plan, and he has smartly allocated his bonds and his REITs, or real estate investment trusts, into his tax-deferred retirement accounts, which is a brilliant move because, well, bonds and REITs aren't very tax efficient, and so putting them in a tax-deferred account makes absolute sense, whereas those index ETFs that are linked to stocks are more tax efficient. You can keep those in the taxable brokerage account. He's done that, so he does a good job in terms of tax efficiency. Last up is performance. Now, this portfolio, these three separate accounts, the taxable, the Roth IRA, the 401k plan, are all committed to low-cost index ETFs, which means JP's portfolio is performed right in line with major market indexes, which is outstanding. That long-term strategy is something I suggest all of our viewers do, and by executing this type of strategy, he's going to outperform 80 to 90% of Wall Street's money managers and traders over the long run. So my final grade for JP's $1.2 million investment portfolio is B+. He does a pretty good job in terms of minimizing cost, minimizing taxes. His performance, I think, has been okay, and it will be okay going into the future. He does need to work, though, on risk and diversification. Otherwise, a fantastic grade, B+. If you'd like to get your portfolio report card, get in touch with me. @ETFguide is my Twitter handle. You can also go to etfguide.com and click on Ron DeLegge's portfolio report card. And if you get an A, I pay you $100. That does it for another episode of Marketplace Minute. I'm Ron DeLegge. Thanks for watching.